Hi, everyone. James Baker here. Today we have another Ask Me Anything meeting. Finally, I think we missed last week, the first week out of like 8 weeks straight. And I'm happy to be here. I'm back at my new headquarters where I'm going to be. So I'm going to be slowly setting it up. But in the meantime, some questions have built up. Some of these questions are a little more technical than we've had in prior weeks. And I'm going to do my best to give an opinion about them. I'm not going to do too much in-depth research on this stuff unless it's really of interest to me. And we're going to just go from there. So question one we have is about that we had in the Telegram chat. I'm a U.S. citizen living overseas. I own 65% of a Nevis IBC. 1 year, the company has, the IBC has 100K in retained earnings or profits, net income. I understand that 65% of this becomes subpart F income on my 1040, so I owe taxes on this. What happens if I spend this money on operating costs? Can I get the tax money back? Can I claim losses, or do I have to bite the bullet and pay tax on the year it came? So here's my answer to that. When you are a citizen and you have an offshore company that pays no taxes, an IBC, an International Business Corporation, you have to report and pay tax on basically your percentage of the profits. And that's only and if this is, first of all, it's very complicated, but generally if you owe 50% or more is when this happens. If you owe 50% or less, then it's not a form 5471 filing if you're not an officer of the company. So if you're not a director and you own 50% of the company or less, so if you own half of the company and it makes this 100K of profits every year, as long as you don't satisfy the PFIC tests, it's potentially you can leave the money in this entity without paying taxes on it in the US. But if you own 65%, then yes, you have to comply with the GILTI tax rules, and you have to comply with the subpart F income rules, and those are very complicated to say the least. So in these situations, you really need personalized advice, because it's just one change, like who's your partner? If it's someone related to you, then maybe it doesn't apply. Or what kind of business are you doing, or how much cash do you have saved up, or are you able to change the ownership? So it's very complicated. And if you can, and generally you can't carry back losses from a CFC, a controlled foreign corporation, but they do carry forward, especially as it relates to the GILTI tax calculation. Again, these are really complicated scenarios that have a lot of nuance to it, and it deserves its own like study or memo written for it if you want to get it done really right. You can't just trust in the advice and a conversation of a tax expert reading a paragraph, because it's not going to be complete. So that's my conclusion on this one, is some tax topics, especially for citizens and offshore companies, can't be answered in a paragraph. They need conversations and research and official opinions for you to be really sure it's done right, because the penalties of doing it wrong are very costly. Question two, we have a Chilean resident who lives in Sweden, a non-US resident that has an LLC, solely owned LLC, I'm reading it directly, offering IT consulting services classified as an ETBUS. That is why the LLC does not pay taxes. Please confirm. Yeah, this is not a very clearly worded statement here. I'll just summarize it based on what I understand. This Chilean gentleman or lady lives in Sweden and has an LLC, and they offer IT consulting services. So based on this, if you just a person outside the US who is as an LLC and is doing services, then there's no tax to be paid. It's not in the US at least, but if you live in Sweden, I imagine you have to report that in Sweden. So that's up to you to figure out in Sweden how to report this correctly, because in the US, if you're not doing anything in the US at all, that's what we talk about all the time. This is pretty clearly, there's no tax to pay in the US. So sounds good. You need to, follow your, do your annual compliance, But yeah, generally you wouldn't pay tax. Question 3 today. I'm going to read it. I know that the LLC owner does not need to pay taxes in the US, but needs to pay taxes at its resident country right. He, she to pay taxes of the profit his or her made the LLC, right? So this goes back to my old question. If you have an LLC and you live outside of the US and you're doing something with it, you're making money with this LLC, you obviously have to check the rules of your home country where you're living to see how the LLC is taxed there. Because if you completely ignore it, you're probably missing something. I am a US based CPA. I know the US tax laws. I don't know the tax laws of every country, although I have clients in many countries and I have a good understanding of the tax laws in those countries. I do not claim to be an expert because I don't like it when people claim to be U.S. tax experts and they're not, and it gets confusing for everyone. So, you have to get a local consultation. For some countries, I can give you a really good understanding of what you should be doing and what the laws say and how it goes, because I've talked about it, like Spain or most European countries or South American countries or Central America. Like I understand pretty well how it works. But you still, especially if you're in higher volume, you need to check with your local person. If you don't have one, maybe we can hook you up with one. Okay, I have a message from the chat from my guy Isaias. I have a multi-member LLC with 2 owners. Since my partner is leaving the business, I plan to add my Dominican business to be 1% member. Is it right to do so with me being the person in control, or is it better to change to a single member LLC? So if you want to have an LLC where you own 99% and your local business owns 1%, it's not a bad idea because it gives you a little bit of flexibility in how you can distribute your profits at the end of the year. So it gives you flexibility, whereas you can attribute more profits to your Dominican company or your whatever country you're from country, to receive more of the profits if it's beneficial to you, or you can allocate the profits to yourself and just use that 1% owner in order to file a partnership return and still be a U.S. partnership. So I have a lot of clients that do something like that. They'll do a family member, or they'll maybe do a foreign company if they have one. It's not a bad option. And this is one that I don't know all the answers to, but I'll read it anyways. So apparently, in order to run a business on OPT, which is as an F1 student visa, you need to meet the 3 main criteria: be actively involved in the business, have all legal paperwork and licensing, be related to your major. Oh, cool. So you can be self-employed on OPT if it's related to your major. That's awesome. What point should I start filing for OPT? I mean, filing for OPT is awesome because you can get a social security number. So I would file for OPT. I would go for it without a client so that you can get your social security number. And assuming you're looking for clients, you are actively involved in the business. If you're spending, 20 hours a week, 30 hours a week, you're actively involved in the business. And even if you don't have clients, the act of looking for clients is considered, a business thing. Yeah, I don't know all the rules for OPT, but I imagine that you can engage in the marketing and the researching and be actively involved in your business and just document all of it, because you're going to have to fill out forms. I've hired people on OPT before, and I had to write summaries and write some letters and fill out some forms so that the school had them qualified correctly to, for the OPT, so they qualified. If your business is doing over 7K a month with a few clients, what happens when your OPT ends? No, I believe you keep the business, because you don't. If your OPT, what happens if my OPT ends and I'm doing my own business with an LLC? Your LLC doesn't close administratively. This is a really interesting scenario. I'm going to talk to my immigration attorney about this in more detail, because I didn't really know about this, to be honest with you, and it's pretty interesting. For tax reasons, I have funds that need to go from a US LLC to a Belize IBC that owns it, and as an owner draw. Then that money needs to be paid out from the IBC as salary to my husband. I am an American in Albania, so setting up the banks are difficult. Oh, this is similar to the other question. The problem is that the Belize IBC bank and the USA bank where the money is going are having trouble sending wires between each other, and the forms don't match up. The question is if the LLC puts money, I don't even want to read all this. Okay, so the real question is that, can I deduct something that wasn't directly paid for by my business bank account? They're basically asking, can we consider something salary if it goes from the bank to the owner instead of through all the layers of ownership? And I don't have a technical answer for that, but most of the IRS works on facts and circumstances. So if you have it all documented correctly and procedurally, you just can't make the transaction happen because of the different jurisdictions, you can classify it as wages. However, one thing to note is that Belize changed their laws a year and a half ago. And I have a Belize tax expert I'm doing a call with shortly so that we can go over the Belize IBC, the Belize corporate structures, and the different pros and cons of using Belize companies. And, I don't think it's as good as it used to be to use a Belize IBC just for like an offshore holding company. So it's interesting that this is another question with a very complicated tax structure, especially for a U.S. citizen. And it looks like they're doing DIY tax research or doing research like this. It's a little complicated. So I'm not really giving you the best answer or a tax technical or research answer, but what the takeaway should be here is that the IRS works on facts and circumstances, and that if you have it well documented and it's not the most standard way because it was impossible, it's possible to get the IRS to accept that. The second point is that when you're a U.S. citizen, you have offshore companies, it's very complicated. You should seek professional advice. Okay. Okay, question 7, it says, I've gotten this question a number of times. Okay. I have a new foreign-owned single-member LLC. It's not yet earning money, and I want to put money in the company. How do I legally loan $10,000 to my company? Well, the U.S. LLC, you wouldn't loan it. You would just contribute it to the LLC. It's just your equity in the LLC. So you're not loaning money to it. You're really contributing money and then distributing it later. So it's not really a loan. A loan needs to have interest computed and calculated and paid, while a regular contribution doesn't. And that's really what it is. Owners don't really loan money to their LLCs. They contribute it because you can take it out without any kind of dividend or distribution or anything that you have to do. So that's how you would do it. If a CFC pays out dividends, are those dividends subtracted from the net income and used to determine subpart F or guilty? Interesting. Okay, we have another technical CFC question. An American owns 65%. So I think this is the same person asking a follow-up question, and we have it separated here. We'll read the whole example. An American owns 65% of a Nevis IBC, and the remaining 35% is owned by Europeans. So it is a CFC for the American. 1 year, the Nevis IBC has 200,000 in net income, or 100,000 net income, and then the rest is paid in dividends. The American receives 65,000 dividends and pays tax on that. Does the American also owe guilty or subpart F tax on the 35%? Those paid to the Europeans as dividends. I don't think so. So I'm actually gonna guilty tax calculation, gross income, salary testing. I mean, potentially, even if it's distributed, I feel my gut answer is no, that you wouldn't have to pay taxes on it. You wouldn't have to pay taxes on the part that was sent out by dividends. I'm just pulling up all these different brochures and calculations. Okay, so we have step one, tested income, net deemed tangible income. Honestly, I don't know. Oh, here it is. This inclusion, the inclusion percentage. I've done this like 20 times. Potentially. So the answer is potentially. This is too complicated of a question to get a really great answer on our free calls because it's not super common. And it's something I need to research and make a presentation for because I don't remember all this stuff, especially that. Because my best friend Tony here has a question and he's asking, is there any connection between IRS and the banks where we have an account? Do the banks have to communicate to the IRS customers' information? So I'm going to answer that in English and then I'm going to answer it in Spanish because that's a great question. How do the banks and the IRS share information with each other? And from my understanding is that the IRS, there's no automatic sharing of information. The banks will automatically file tax forms and they'll issue how much earnings people have at the bank. So if you have an investment account at the bank, they'll tell the IRS how much money you made. I'm not sure how much other details go in, but it's not like other countries where the IRS is completely integrated within the banking system. It is separate and the IRS would have to contact. So if I get audited, the IRS doesn't just have a list, at least from my understanding, and from my experience, the IRS doesn't have a list of all the accounts where I'm a signer at the bank. They don't just have that. They can get it or figure it out with the Patriot Act that passed in like 2001. The US government can do whatever it wants, but it generally isn't like other countries where it's a constant flow of information. They just have it and they're analyzing it. The IRS has to actually request it and have a reason to request it. And before the IRS has the information. So while it's available, while the IRS and US banks share the information, you can say it's available, it's not automatically pushed through the same system. The IRS is not involved and integrated into the banking system like it is in other countries. And there's no like withholding on any payments. Like this is mostly there's mostly like they're separate entities. And the comment here, in other countries like Italy, the bank must share everything. Yeah, so there's no pipe of information where the bank is just pushing out all their data to the IRS. And that's like transfers, deposits. It would be more likely that this would be the case with FinCEN, the Financial Crimes Network, because they have a little bit more leeway and get into the banks even more. And I got anti-money laundering licensed. I got my license for that. And I learned a lot about FinCEN and money laundering and how all of that whatever is found out. And money laundering is a big tool for money laundering is the banking system, right? And to fight that, FinCEN, the banks send reports to FinCEN when there's suspicious activity. So the banks are probably, and this is again all speculation, but the banks are probably more likely in the US to share information to FinCEN, the Financial Crimes Network, than they are with the IRS, because it's just the only information they share with the IRS are the tax forms. So that's kind of how it works, and that's a big benefit of being in the US. Yes, the IRS is the most powerful collection agency, and they can take money from anyone, anywhere, but they don't really do it if you stay on top of your stuff. You file your taxes, you file all your forms correctly, you comply with all the rules. It's fine, and no one asks about you, and that's how it works for 99% of people in the world.